Louise Bedford here. I am so glad you're joining us for another episode of Talking Trading. Do you know that we actually produce the audio for Talking Trading that goes onto the website, but we also produce a set of videos and they go onto our YouTube channel. So go to youtube.com and /trading to be able to get to our YouTube channel, and you'll be able to see videos. It's a funny thing that with technical analysis, often we need to show charts. So it's hard to use audio as a medium. We need video to be able to create that visual for you. And really, I'm so pleased to be here today. It's exciting. Chris Tate and I have flown to Sydney to be with a friend of ours as well as a fellow trader, Jason McIntosh. Jason has been a regular on Talking Trading. We have interviewed him so many times because he brings such value to our audience. His segments are always one of the most requested and the most watched. So welcome to the show, Jason.
What an introduction. And welcome back to sunny Sydney. Great to have you guys back up here again.
It is so nice. We just feel like we're spreading our wings again because after such a long period where we couldn't fly, this is our very first flight out of Melbourne. So exciting.
Absolutely.
Now, Jason, you have got so many different aspects to your trading. Firstly, what we'd like to do is quiz you in a few areas because I've had a list of questions from the people who are our mentor program attendees, and they also use your service. Quite a few of them use your service. So if you could first of all start by telling us a bit about your background, about your service, and also then I'm going to start talking about some of the differences, the key differences between the way you trade and the way we trade. So tell us a bit about your business.
Yeah, well, look, I started back in the markets it was 1990.
Same with me.
And there we go. Point of connection already there. And so yeah, look, it was back in 1990, and it was with an investment bank. So I had a bit of luck. I got a foot in the door into a large American investment bank, and called Bankers Trust. The name's sort of like dipped from memory for a lot of people now, but at the time it was sort of like one of the places to be, and found myself in the charting department. And that was by complete chance. I could have ended up on the futures floor, but as you know, the sliding doors have it, I found my way to the charting department. I didn't know anything about charts. I'd been to uni, I'd studied economics, and the professor said, look, these charts, it's rubbish, markets are random, you can't get an edge trading on charts. So that's the sort of mindset I went in with. But look, I'm pretty open to these things. I didn't really like the economic side anyway, too much reading, too many balance sheets, too many economic statistics.
Complexity, yeah.
It's like it wasn't really my thing, so I was quite open to this new way of approaching the markets through looking at charts, because I'm quite visual in the way I like to analyse things. So the chart looked like a good idea, and I was so lucky because my mentor, my boss, he was one of the best chartists in the business. So not many of us get to start that way. Most of us start with a bunch of losses, a couple of books, and trying to piece it together bit by bit.
And a lot of hope.
Exactly, yeah. So I had this legend of the charting market teaching me what to do.
Yeah.
So that's how it all began, and there were so many talented people in that Bankers Trust dealing room. I remember the head of the algorithmic trading desk came in one day, and so BT had all these highly talented people, and this guy came in. He was one of the smartest guys in the room. And he said that he could statistically prove that markets moved in trends. So this was a revelation, because as I was saying, all these professors were saying markets are random, but then I've got this star of the superstars telling me that he could statistically prove this, that they move in trends. So that had me really interested. I was just fascinated with the charts, fascinated with the trends. The algorithmic side was something which came into my path later on.
And when you say algorithmic, I know some people will be very new to Talking Trading and new to the world of trading. Perhaps you could describe a bit more about algorithmic.
Yeah, so algorithms are great in that what an algorithm does, it basically allows you to program what you're thinking in your head into a computer, and then the computer goes and does all the number crunching. and it allows you to cover so much more ground. Now, there are all sorts of algorithmic approaches. You've got the high-frequency traders, you've got the mean reversion traders, you've got the trend traders, which is what I am.
And that's what I am too. So that's where our commonality is, yep.
That's right. So our algorithm is very broad. There's not a single type of algorithmic trading. All it's doing is using a computer to do a lot of the work. But you've got to program it. You've got to tell it what you're looking for. So for me, it's telling, and this is what I do with my motion trader service. So I've told the computer what I wanted to do. I've told it I wanted to identify trends, and I've said how I want them to identify trends with a set of rules. And then I've said how I want the stock to be exited, either at a profit or a loss, depending on what the stock does. And I've told the computer, or programmed it to spread risk across many small, relatively small bets, and various other things. So it's got that background and that precision in what I want. So it means it can act with consistency. Because I think this is a problem for a lot of traders: inconsistency. So they'll have an idea and they will they'll have a go at that. They'll put on a few trades. Doesn't work, then they'll jump over and they'll start doing something else, and they end up with this hodgepodge of a bit of this and a bit of that, and it's a mess.
It's a problem too, because you don't ever really know what it is that you've done that created success and what you've done that created failure if you're not very systematic. And of course, spoiler alert, I've been using your service. I use your service to diversify from my own mainstream trading, and it's a great way to smooth returns. So with your service, before I forget, because I'm likely to forget as I ask you some of these questions, I know you've organised a special offer for some of our traders if they'd like to have a look at your service. Maybe we could just start with that and then we'll delve into some of the areas that you cover.
Yeah, that's a great idea. So I've set up a 2-week free trial. Look, the best way to get an idea of how all this works is to come in, have a look at the training videos which I put out, have a look at the trade signals, the weekly mentoring reports which I write, which is all about transferring my experience to my members. So it's not about, I think a lot of people hear the word algorithm, they think black box, and what does that mean? It's like you're going to get, these signals are going to get spat out, you won't know why they're coming out, how it all works. That's all well and good when you're winning, but as soon as you start losing, if it's a black box sort of system, it's unfollowable. So that's why I spend so much time and explain the process, which is what you do as well. It's all about process and system.
We use algorithms as well. Like for our scans, even the ones that we teach the members of our mentor program, that is all based on systematic scans. And you're using a different scan, but certainly one that's based on logic.
That's right. And look, if people would like to come across and have a look, it'd be great to have them for a couple of weeks. Just go to motiontrader.com.au /talking trading.
Perfect.
Fill in the details and all set with a 2-week look at how an algorithm can approach ASX stocks. And it's amazing some of the ideas, some of the stocks that come up in the screens. So look, it depends what the ASX is doing. If the market's falling, there's not so many signals. Because it's not like, I don't operate on a quota system like some services. That's kind of how it is. You get one idea a month, whether the market's going up or down or sideways, one idea a month or 2 ideas a month. This is more about, I'm more interested in making money than creating excitement. So if the markets are trending in the right way, well, we get signals, and some of the signals are really interesting because I'm covering the whole market, and this is the big thing with algorithms, because you can cover so much more ground. So back in the day in the charting department, I'd be there, I'd have all my printouts, I'd go through one by one, but how many stocks can you cover that way? Like you could cover maybe the top 50, as I got good at it, I'd cover maybe the top 200, but it might take me a few days to get through it all. Now I go through the entire ASX listings in each afternoon. It takes about 30 seconds of running the data through the algorithms. So that provides a lot of really interesting ideas to then the way I do it, I just go and invest in whatever signals come along when I've got capital. But some of my members then use that as a hot list to then go and apply their fundamental overlays on top of that. So there's different ways of doing it, but it's all idea generation.
And that is one of the things that I've heard where people are surprised that I love your service and that I use your service because they go, well, why don't you just trade your own system? It's because it is good to have another trader who has got a level of experience, usually surpassing the people who are coming to you, and that way you can get a different view. That system diversification is fantastic. So a few of the differences and similarities, I want to delve into that now because I just find it fascinating. One of the biggest questions we get asked about you is, what about if a position that you're thinking of getting in has gone up a lot, and do you enter that? Now, I've got to say, this is one of the areas that are potentially a difference between the two of us. I use candlesticks to tell me whether to enter, but you have a set rule, don't you? If something's gone up too far, you know when to enter and when not to.
Yeah, it's look, for me, it's a combination of science and art. So from my systematic side, it's science. So what I use look, and it's not complex either. It's really quite simple. So I work out where the five week low is, because you've got to be able to tell an algorithm or code an algorithm to do it. So it can't be too airy-fairy. It's got to be very clinical and clear cut. And this is one of the great things about this, the consistency you get from this approach. So I get the 5 week low, and the rule is don't buy if the stock is up by more than 35%. So why 35%? Well, I do a lot of back testing. And look, I could use 10%, I could use 50%. The thing with the way I back test is you're not after the single best parameter. You want to get a parameter which loosely fits a lot of situations.
Yes.
And that makes it robust over time. Because the problem a lot of people have when they do back testing is they over-optimise and they curve fit and they find the single best parameter. But that tends to break over time because markets are always changing. So you want nice, loosely fitting parameters. And so I've used 35%. You know, it'll work either way.
This is gold. Do you know, this is probably one of the biggest areas that people ask us questions on, because we don't have a set rule that is so objective. So if you're listening to this and you're looking for something to apply immediately, I think this is something that you can do just like that. Now, one of the other areas that I'm finding fascinating is your views on time stops. Tell us, if you have been in a position for a while, how long is too long? You're just waiting for it to do something. It's not getting stopped out. It's not going up enough for you to actually move your stop up or to pyramid into. How do you implement a time stop?
Yeah, this is an interesting variation which I've brought into what I do. So what I do a lot of back testing, and then when I do the back testing, like you get all the data and you see the equity curve, and that's all good. But I like to understand the trades behind that equity curve. So then I'll go through and I'll look at a lot of the trades from that back test. And what I was doing, I was going through, looking at them all. I noticed there was you'd often find stocks which signal a trend, but then the trend just doesn't do very much. It just starts going sideways, doesn't stop it out. Doesn't run, it just meanders, and that could go on for months, could go on for a year.
Absolutely. And I think some of those ones that I've been involved with, everything's perfect. You get in and then it just, I'm not going to do a thing now.
And that happens.
Yeah.
And some people are surprised when that happens, but that's just how markets work. And so what I do with my own portfolio, so I don't do this with my motion trader portfolio because that effectively has unlimited capital. It will just keep triggering the signals when the signals occur, and then members can decide if they want to apply a time-based exit strategy to themselves. So with my own portfolio, like everyone, there's limited capital. So I run around 80 stocks, up to 80 stocks in my portfolio. And like if I've got 20 stocks going sideways not doing much, that's just taking up space which could go to new ideas. So I use a 60 trading day time exit. So if we get to 60 days and the stock is not in profit, I'll exit. Or if on day 70 or 80 or sometimes in the future it comes back and dips below the entry level, I'll exit. So 60 days isn't a magic number. 50 days works, 70 days works. I tested probably parameters from 10 days to 120 days. And what I found, if you make the time exit too close, like 10 days or 20 days, you get too much turnover and you're not giving a trend enough time to continuous momentum, and it was counterproductive. You go to 120 days, then it kind of started to become like you might as well not have the time exit because you've given so much time. So the parameters that work were around that 60 days, 50 days, 70 days, somewhere in there, and that just helped free up capital. Now, there is something to be aware with time exits, though, is that you get more losses, you get a lower win rate because you're closing stuff down which is at a loss. Now, that's not a concern for me because I'm not measuring my success by the win rate. I'm looking at the total gain. But that said, low win rate systems can be emotionally harder to trade. Like it's funny. So like as humans, we like positive reinforcement. This is why people love taking lots of small profits because they're getting that positive feedback all the time. Look, I've made money.
Rushes.
I'm right. Then you come over to me in trend following world, and all of a sudden, at least half the stocks end in a loss. They're relatively small losses, but nonetheless they're losses. So as that win rate declines, the emotional strain also declines because you can get sequences of losses. Relatively small, but losses none the same. So you lose that positive feedback mechanism. So this is what I say to people. I say, look, if you don't mind a lower win rate, have a look at the time exits because it can make your capital more efficient. Because you exit something and then you redeploy it into a stock which is showing a new signal with new potential. If you don't like that greater turnover, it's not that much more turnover, it's maybe 20% more turnover, thereabouts. It's not that much more turnover. Nonetheless, it's more turnover, lower win rate. If you don't like it, don't do it. If you don't mind it, well, that's a
and taking into account as well, because you're a medium-term trend follower. So if you're trading a 4-hourly system or a daily system, clearly that type of time stop would have to be adjusted for the different time increment on your chart. So take that into account when you're looking to find things to apply to your own trading. As well, I think the thing that I'm going to urge everybody to do is to look for the similarities rather than the differences. When Chris and I are interviewing people and talking trading, sometimes I know you will hear some things that are different from the way that we've been educating you, and that is just fine. There are lots of ways to make money. I do urge you though to hear how similar some of Jason's views are to the views that Chris and I hold ourselves, because really I think you can fail a lot, you can lose a lot of money in that learning curve. Why not follow somebody who has already started to go, hey, my system is so complete and so good that I can show you how to do it. And I think that is a real key in this world also.
Yeah, it's like it's really important to understand there's no holy grail on this. That there's this one magic approach which is going to just work. It's lots of ways works, and not even fundamental ways. It doesn't have to be a technical way. There are all sorts of approaches that work for different people depending on like how they want to structure the way they operate in the markets. And it's completely okay if two successful traders to have differences in how they work it.
And that's some of our favourite discussions with you, Jason, because the differences make it interesting. I want to also...
But the thing which is always the same is process and consistency. The process doesn't have to be identical, but there's a rock solid process that can be, and if you can explain it to someone from start to finish, then you have a process. And then if you can consistently apply it, then you're in the game.
Yeah.
And that's what it's all about.
I love it. And what about if something has gone up and up and it then drops, it hasn't hit your stop? Do you make a judgment call about when to get out?
Yeah, it's really interesting. It's there's one of the traders who I modelled a lot of my early career off and my current career off, this guy called Ed Sakota.
Oh.
So he's one of the pioneers of algorithmic trend following trading, and so I first read about him in Market Wizards back in, I think it was 1993. It was in my first few years in the market. So I refer to him as one of my mentors who I know through print. Never had a connection with him personally.
Chris Tate has. Chris Tate and Ed have emailed. Ed just signed it off. Ed, not like Ed Sakota, just Ed.
How good is that?
It's It's wonderful.
So it's like, I've got a second degree connection to one of my heroes.
That's it. It's great.
Yeah. So it was so Ed said there are five key rules. He said, let your profits run, cut your losses early, many relatively small trades, stick to your rules no matter what. And number five is a cracker. Know when to break the rules. So it contradicts 4, but it's a really important thing. You don't often do it. Just occasionally you need to break the rules. And so I had a stock called in my portfolio. This is one my motion trader members. A lot of them had it too. A stock called Jumbo Interactive.
I had that based on your recommendation.
Is that right?
Yes. So that's
Did you write it to the end?
I wrote it until you said to get out.
Ah, very good.
Yeah, and I know this is why the source of the question, because I know that you technically broke the rules there, because you had some specific rules, things were going crazy, and then you thought to yourself, based on what you've seen in the past, this is now no longer cooperating in a standard form of behaviour. There was a certain manic aspect to it, and you said to exit, which I did, and I was very pleased.
Well, that's pretty close to how it all works. So at the time I was running a 40 stock portfolio, so I was investing 2.5% of capital in each idea, so relatively small trades. Jumbo went up something like 800%. And
I noticed.
As any good trend follower, I didn't exit. I wrote, let the profit run. Rule number 1 of trend following, let your winners run, because you make most of your money from those outliers and mega trends that go many hundreds of percent. And it's really important, you've got to maximise your gains when they come along. So they don't come along every day. So when they do come along, you've got to grab on and you've got to ride them. And so it's gone from 2.5% to, it was something like 15% of my portfolio. So now it's becoming quite a chunky position. So if it went to 0 overnight, which I wasn't worried it was going to do, but if it did, my portfolio is down 15% overnight. So that's a big movement. Whereas ordinarily a stock could go to 0 overnight, I'm down a couple of percent, big deal. So becoming quite weighty, and I looked at the chart and it looked like a .com stock. It was just parabolic when you looked at it on a weekly chart. So what I did, I sold a third. I grappled with this for a while. I didn't want to break the rules, and because the reason I had such a large profit was because I resisted the temptation to sell. It's so important. And but with it being such a weighty position in the portfolio, I thought, look, I'm going to take a third off the table, ran the other 2/3. Over the next probably 3 or 4 months, it came back, hit the trailing stop. It was an uneventful exit. I ended up with probably around 500 and so % profit in that. The stuff I got out of early, maybe it was a little bit more, maybe it was a 600 and something % profit, but all worked out well. So that's one occasion where I've broken those rules with an exit. More often than not, though, I'll stick to it because it's calculated, it's consistent, it's not there to second guess. Sometimes it's hard. We grapple with ourselves. Everyone will have some point where something's emotional for some reason, and you've got to struggle with yourself. But most of the time, at least 95% of the time, I'd say, look, I fly by the rules. But being human means sometimes it's just hard not to tamper. But the less you tamper, the better off you are.
I totally agree. And for those members of our mentor program and our graduate program called the Boardroom, you may notice that there are some similarities between what Jason has implemented there and my windfall profit stop. That removing a third in times of manic behaviour is something that we both follow. So it is interesting to see how we have to be a little flexible sometimes when things are becoming manic. Now, Jason, what is a question that you wish I had have asked you? Is there something else that you would like to explain about the way you approach the markets that we haven't covered?
Look, I think a really important point for people to understand is that they've kind of got to embrace volatility. So many people spend so much effort trying to dial volatility down, but market's volatile. And if you're trying to avoid volatility, what you tend to do, you tend to be avoiding profitability. Because the two go hand in hand. It's so in the way a trailing stop works, for instance, so often people will they'll want to, like, I think over time, I think so much potential profit has been foregone with people trying to protect open equity. So they'll have, say, a 50% profit in a stock. They go, look, I'm up 50%, this is really good, I don't want to give that back. And I understand I need to let profits run, but I don't want to give much of that back, so I'm going to set a 10% trailing stop. So I'm letting my profits run, I'm being a trend follower, I'm letting my profits run, but they're kind of not. Because as soon as they've jacked up that trailing stop to 10% below the current price, the clock's ticking.
That's it.
They're coming out.
Yeah.
Because you can't ride a trend to 100%, 200%, 300%. You can't ride Jumbo Interactive to 800% profit with
You'll
a 10% trailing stop.
Times of drawdown that will well exceed that 10%. And if that takes you out while that primary trend is in place, you've left a lot of money on the table.
And this is why it's so important. Like, I sometimes get people will send in an email saying, look, I understand the process, I understand what you're doing, but these trailing stops you run, they're crazy. It's so risky.
So wide,
they're just too big. I couldn't. One woman, she came in and 2 weeks later said, no, I need to cancel, I want my money back. I couldn't sleep at night. This is way too risky. And it's like, well, trading probably isn't for her. And that's okay. A lot of people shouldn't be trading because trading's hard. You know, a lot of promoters will say, look, it's easy. This is easy. Just do this. But it's rubbish. It's hard. And if you don't like volatility and you can't use a wide trailing stop, you shouldn't be trading. You should give your money to a fund manager, and then they'll do all that, and that's okay. Nothing wrong with doing that. No point putting yourself into an emotional situation that you can't manage effectively. Because I do a lot of back testing.
Yes,
so
we do too.
This is, and I write this up in my mentoring reports to try and, because the great thing about back testing is you can prove things. You can show it. It's not just some guy telling a story. It's like I'll tell you a story and then I'll back it up with the back testing. So I did one on Jumbo Interactive, and I said, okay, this is the motion trader outcome. Had you used a wide trailing stop, you ended up with this 500 or so % profit.
Yeah.
Now let's see what happened if we ran a 10% or a 20% trailing stop. Let's see what happens now. So instead of one trade, which goes from here to here and goes up 500 or so %, you end up with a series of small trades, which the net result comes to much less because it's constantly having these 10% pullbacks. You have the 10% trailing stop, but you're probably struggling to make $1 on it at all. And then you add in your transaction costs and everything else. 20% is better, but to ride a really big trend, a stock is almost certainly going to pull back by more than 20%. So I'm using a calculated stop. It's called an ATR stop. Or it's called, ATR stands for average
true range.
Average true range.
Yeah. That's
It's measuring the average trading range of a stock, and then you apply a multiple to that average, and that's where your trailing stop is. It's clinical, it's clear cut, it's calculated. I actually trade better with the calculated trailing stop myself.
Yeah,
if I'm using a discretionary stop, it's always like, oh, have I got it in the right place? Should I tweak it a bit? When it's calculated, you just know why it's where it is, because it's based on 20 or 30 years of back testing. That's just where it is. It's not magic. It doesn't work with precision every time. Sometimes a stock will come back and trigger the trailing stop and then rally again, and that's a bugger, but it happens. But what the trailing stop is there to do is there to protect you from the stocks that continue falling. So the problem isn't with the ones that rebound, it's with the ones that continue falling. And a lot of people are there averaging down when it keeps falling, but someone with a trailing stop strategy and applying it effectively, they're just getting out and moving on to something else. And so look, that's the thing. I think you've got to have those wide trailing stops, give them lots of room to move, and then have the discipline to follow them, get out when they trigger.
If you are completely new to the markets, I can understand that some of these is going to be complicated for you because you're not familiar with the jargon. Give yourself time. I bet you when you listen to this interview in about a year after hanging out with us, you will understand 99% of what we've been discussing. So give yourself time to grow. Don't give up too early, and look for those similarities between the ways that we approach the markets, we being me and Chris Tate, and the way Jason approaches the markets. And Jason, for people to get in touch with you and to capitalise on that 2-week free trial, could you just give us those specifics again?
Yeah, so just simply head over to Motion Trader, so motiontrader.com.au/talking trading. Just pop those details in, and then we'll set you up that 2-week free trial. And you know, the thing with trading is I say it's not easy, but it's also not rocket science. It's like, you know, some of the terms like a trailing stop, if you haven't heard that before, it's like, well, what does that mean? It's nothing too tricky. It's simply an exit point that moves upwards as the share price moves upwards, so you always know where you're getting out. Because I think that's the hardest part for most people. It's like, when do I sell? Like, everyone wants to tell you when to buy, but no one wants to tell you when to sell. And so this is one of those strategies that I talk a lot about, because it's all about, like, for me, and as I know it is for you, it's about explaining a complete process to people. It's not about saying, oh look, this is the latest indicator to tell you when to buy. Well, you know, so what? It doesn't mean anything on its own. The hardest part is knowing when to sell. But it's also, you know, you've got to know when to buy. You've got to know how to spread your risk. You've got to know how to set your trailing stop. You know, nice wide trailing stop. You've got to know how to position size. You've got to know how to exit. You've got to know all these different things. It's not hard to, once you understand the process. Understanding the process isn't hard. Applying it can be harder. But it's, as I say, it's not rocket science. We use very, very simple indicators like moving averages and breakouts. It's the best systems are often the simpler systems. It's, you know, I see some people they've got RSIs and MACDs, and they've got Bollinger Bands, and
it's crazy.
they've got 3 screens on the go. It's just utter confusion. I don't know where to look. Whereas my entry into a stock, it's based on simple indicators like a couple of moving averages and a breakout strategy. A few other little bits and pieces in there to avoid volatile stocks, overly volatile stocks, but yeah, it's pretty straightforward.
So go to motiontrader.com.au/talking trading, because this is really a way for you to immerse yourself in a system that is robust, that has been working for years, that is designed by somebody who Chris Tate know and trust and like. And the fact that I'm using it myself, of course it's easy for me to recommend your services. So I'm just so glad that you've come onto Talking Trading to share your wisdom. I've loved it. Thanks so much, Jason. No doubt we'll be seeing you in another Talking Trading episode shortly. Thanks so much.
Oh, fantastic, Louise. It's been really good to come on and have a chat, and look, hopefully that's interesting to people, what we've been through and what we've talked about, and hopefully there's a few new ideas there.
Love it.